In 2022, the stock market dropped 18%. In 2020, it dropped 34% in 5 weeks. In 2008, it dropped 57% over 17 months. People who tried to time those drops, waiting for the right moment to invest, missed what happened next. People who invested on a fixed schedule every month, regardless of what the market was doing, didn't need to predict anything. They ended up with more shares bought at lower prices, and the recovery did the rest. This investing strategy is called dollar cost averaging. This video explains exactly how it works, why it performs better than trying to time the market for most investors, and the one situation where it doesn't apply. What dollar cost averaging is. Dollar cost averaging means investing a fixed dollar amount at regular intervals, regardless of market conditions. Every 2 weeks or every month, the same amount goes in, whether the market is up, down, or flat. The effect? When prices are high, your fixed amount buys fewer shares. When prices are low, the same amount buys more shares. Over time, your average cost per share is lower than the average price per share during that period. That's the math. More shares accumulate at lower prices. The average entry point is pulled down toward market bottoms rather than toward market peaks. The 2022 example. Imagine you invested $500 per month throughout 2022 into a total market index fund. January 2022, market near all-time high. $500 buys X shares. June 2022, market down 20%. $500 buys 1.25X shares. October 2022, market down 24% from January. $500 buys 1.32X shares. January 2023, market starts recovering. The person who invested every month through 2022 ended the year with a lower average cost per share than someone who put a lump sum in at any point before June. And they captured more of the 2023 recovery because they owned more shares. The person who waited for the market to bottom before investing, trying to time it, faced a problem. The bottom only became visible in hindsight. By the time it was clear the market had bottomed, it had already recovered 15%. Why timing the market fails? Research from multiple academic studies shows the same result. Most investors who try to time the market, moving in and out based on conditions, end up with lower returns than investors who stayed invested the entire time. A study by Dalbar tracking investor behavior versus market returns from 1992 to 2022. The average equity fund investor earned 6.4% annually over that period. The S&P 500 returned 9.7% annually. The gap, 3.3% per year, comes almost entirely from buying and selling at the wrong times. Investors tend to buy high when the news is good and sell low when they're scared. Dollar cost averaging removes that tendency by removing the decision entirely. You can't panic sell during a correction if you're on an automatic monthly investment schedule. The automation protects you from yourself. How to implement it. The practical version is already built into most people's lives. If you contribute to a 401k through payroll deduction, you're already dollar cost averaging. Money is pulled from your paycheck every pay period and invested regardless of market conditions. For a Roth IRA or taxable brokerage account. 1. Set up a recurring monthly transfer from your bank to your investment account. Most brokerages, Fidelity, Vanguard, Schwab, let you automate this in under 5 minutes. 2. Set up an automatic monthly investment into your target index fund. The shares purchase on the scheduled date without you deciding anything. That's it. The system runs without decisions. The market goes up and down. You buy every month. You don't watch the news to decide whether to buy this month. You bought last month and you'll buy next month. When DCA doesn't apply. Dollar cost averaging is the right strategy when you're building wealth over time from regular income. If you receive a lump sum, an inheritance, a bonus, a home sale, the math changes. Studies, including Vanguard's own research from 2012, show that investing a lump sum all at once outperforms dollar cost averaging about 2/3 of the time. The reason is simple. Markets go up more often than they go down. Every month you delay investing a lump sum, there's a roughly 2/3 chance you're missing gains. For a lump sum, invest it. If the psychological discomfort of investing everything at once is too high, spreading it over 3 to 6 months as a compromise is reasonable. But don't stretch it out over 2 years out of fear. For ongoing income, dollar cost average automatically. James at 29. James earns $72,000 and just opened a Roth IRA. He sets up a $500 monthly automatic investment into FSROC's, Fidelity's zero expense total market fund. He doesn't check the account balance more than once a month. He doesn't adjust based on news. He doesn't try to put in more when the market dips or pause contributions when it rises. Over 36 years to age 65 at 7% average annual return. $500 per month grows to approximately $1.07 million. The account value at any given point will swing dramatically based on market conditions. The ending number is determined by the time and the rate, not by trying to be clever about when to buy. The most important action James takes is the one he takes once, setting up the automatic transfer. Everything after that is patience. If you want to know which specific index funds to put this automatic investment into, the exact tickers, the expense ratios, and what proportion at your age, the 3-fund portfolio guide is linked here. And if you don't have a Roth IRA yet and want a step-by-step tutorial on opening one at Fidelity, that guide is the next video on this channel.